I have mentioned in the past that I wasn't quite mentally ready for $100,000 Bitcoin yet. That while it's fun to see the fiat value of your stack go up, I was really feeling the FOMO that I hadn't stacked enough yet, and that it was going to get harder and harder to reach my stacking goal as the price exploded. Well, if you combine that with the fact that I also believed the price of Bitcoin was probably higher than it should be at this point in the halving cycle because of the euphoria associated with the Bitcoin ETFs, and you combine that with just how much fun the memes have been lately, the 58K gang has really started to grow on me. This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy. Guten Tag, buenos dias, morgen, and welcome to episode 178 of the Bitcoin Bulletin Podcast. It is a cooler, cloudy day here on Florida's Space Coast. It's still 86, almost 87 degrees, and the humidity is a solid 80%, which means the air can basically not hold a whole heck of a lot more water than it currently has. But it's been a nice change from the 95, 97 degree blazing hot days that we had in the last part of August. Of course, the moisture building up in the atmosphere is because we are entering the peak of hurricane season. And while it's been relatively calm despite the gloom and doom forecast from the National Storm Prediction Center and the National Hurricane Center, there is a lot more moisture building up and starting to swirl around out there in the ocean. But I digress. I have spent a great deal of time in the last few episodes explaining exactly why I don't believe this cycle's having driven bull run has even started yet, that we're perhaps just now getting to the point where historically we would start to get the first inclinations that a bull run was on the way. But of course, this time, as they say, was different. In January, the SEC approved the spot Bitcoin ETFs, and of course, the price of Bitcoin, which had rallied a little bit in anticipation, absolutely exploded, setting that new all-time high of around $74,000 before we even had the halving, which was something that had never happened before in all of Bitcoin's history. And just like the euphoria phase of any bull run, the price was bound to overshoot, and naturally what goes up must come down. But I think most people did not think it would retrace significantly, or at least not as far as it had, and that we would proceed into the regularly scheduled post-halving bull run as if gasoline had just been poured on the fire. I'm going to get into quite a bit of detail about why I believe we are seeing the price action that we are seeing, as well as cover the latest Bitcoin-related news in a moment. But before I get into all of that, let's take our customary look at Bitcoin's vital statistics. At the moment of this recording, we are sitting at a block height of 859,903, and Bitcoin is clocking in at a US dollar price of 58,190 US dollars per Bitcoin. That is up a bit. We saw Bitcoin drop as low as the $55,000 range last night, but it naturally recovered at least a little bit just in time for me to do my DCA stack. Bitcoin's current price means that we will receive 1,719 Satoshis for every US dollar that we convert into Bitcoin. And while Bitcoin is down a little bit, that's good news because we're going to get about 23 or 24 sats per dollar more than we would have if we were stacking at the price we purchased at last week. Bitcoin's current price gives it a market capitalization of $1.15 trillion, still significantly above that magic number, that $1 trillion mark that the normies, I say, psychologically encourages the normies to see Bitcoin in a slightly different light, to take it more seriously than they would if it were a $990 million asset. There's just something about nice round numbers, and so $1 trillion is the first round number before maybe we get to $1.25 trillion, $1.25 trillion. And then from there, maybe $1.5 trillion. And then the next nice round number after that, maybe would be $2 trillion, then $2.5 trillion, and $3 trillion. And then maybe nobody will care till $5 trillion and then $10 trillion and then $15 trillion when we finally surpass gold's market cap. And of course, on to infinity, as Newt Svanholm would say, although I have a bone to pick with Newt, some of the things he's been spouting in podcasts and in public in the last few days. But that is a tangent that I probably won't even explore in this podcast because we have a lot of other, frankly, more important things to talk about. For those of you who value your wealth in shiny yellow rocks, it will currently cost you 23.3 ounces of gold to purchase just one Bitcoin. And for those of you who value your wealth in pizza, one Bitcoin will currently purchase you 3,254 large pepperoni pizzas from Papa John's as we trend to infinity pizza, in Bitcoin terms anyway. That metric that you know has been my favorite for most of Bitcoin's history, or at least for the history of this podcast, Bitcoin's 24-hour transaction rate is humming right along. Not quite as impressive as the incredible 9.21 transactions per second we saw last DCA Wednesday, but a respectable 8.42 transactions per second. That is one of the highest numbers that we've seen in the entire history of this podcast. I think the 9.2 transactions per second last week was the highest we've ever seen on a DCA Wednesday. So respectable on-chain activity out there, despite the panic. And that is reflected in the mempools. Clark Moody's mempool is showing 152,592 transactions pending, up from 116,225 last Wednesday. And mempool.space's slightly larger mempool is showing 246,968 transactions in their mempool, also up significantly from the 218,212 transactions in their mempool last Wednesday. Along those lines, if you need to send an on-chain Bitcoin transaction, the fees are still about as cheap as we've seen them recently. Clark Moody's dashboard fee estimator is saying it's a little bit more expensive than last week. Last week, they were saying a fee of just 3 sats per VByte would be mined in the next block. Today, they're saying it will take a fee of 4 sats per VByte to be mined in the next block, but they're saying a fee of just 3 sats per VByte will be mined within a day, and that's reflected in the blocks I'm looking at in the Block Explorer, because the last block, in fact, did have plenty of 3 sat per VByte transactions that were mined. And a fee of just 2 sats per VByte should be mined within a week. Mempool.space is telling the exact same story. A priority transaction should include a fee of 4 sats per VByte. That works out to about 33 cents US dollars in US dollar terms at the current price of Bitcoin. They, however, are saying that you need to include a fee of 4 sats per VByte for any transaction, whether it's a priority transaction, medium or a low, or even a no priority transaction. And that might be a little skewed because it's been about 16 minutes since the last block. So the fee estimators tend to tick up ever so slightly when the blocks are coming in a little bit slower than average. So I wouldn't be surprised if that slides back down to 3 sats per VByte. Last week, however, mempool.space was recommending a fee of 5 sats per VByte for a priority transaction. So fees have trended down on mempool.space and up on Clark Moody's dashboard, which is an example of why it's important to get your data from multiple sources and to make sure you have the most accurate, most up-to-date data before you try and lowball a transaction. If you do have an on-chain transaction you want to make and you want to squeak it in as cheaply as possible in Satoshi terms. We are exactly 921 blocks away from the next Bitcoin mining difficulty adjustment. As you're probably aware, the Bitcoin protocol adjusts the difficulty it takes to find the next block every 2016 blocks, which theoretically works out to about once every 2 weeks, with the goal of having blocks come in at an average time of 1 block every 10 minutes. When blocks are coming in a little too fast, it increases that difficulty. If blocks are coming in a little too slow, it decreases that difficulty. And currently, it looks like the next difficulty adjustment is going to be an increase. That's going to happen probably next Wednesday, September 11th. So next DCA Wednesday. And depending where you get your data, it should be an increase of anywhere between 1.67 and 2.5%. So not a significant difficulty increase, but an increase nonetheless. And that is because blocks are currently averaging 9 minutes and 45 seconds. Obviously, that is faster than 10 minutes, and hence the difficulty increase that we'll see in just 929 blocks. Currently looks like there are approximately 613.8 exahashes of mining power securing the network. Of course, that's a 90-day average, and that is based on an estimate of how, based on how fast. It's an estimate based on how fast blocks are coming in. There's no way of knowing exactly how many miners are plugged in and online. But if you average it out over a significant period of time, whether it be the 2016 blocks that some people estimate by, or 90 days, if you want to use a fixed human amount of time, I think gives you a pretty good idea. And that is a slight increase from last DCA Wednesday, when it was estimated there were 608.4 exahash securing the network. So about a 5.5 exahash increase, which is why we see blocks coming in ever faster, and why we're going to see most likely an increase in mining difficulty next Wednesday. Of course, that really only matters if you're a home miner, or particularly if you're a large-scale commercial miner. If you were a pleb like me and you're just sending transactions to and from maybe your hardware wallet, the difference between 10 minutes and 9 minutes and 45 seconds is really immaterial, especially since that's just an average. So regardless of how much hash rate is out there, it's possible that a block could come in less than 10 minutes, significantly less than 10 minutes. I've seen them come in pretty much back to back before. And at the same time, there have been plenty of blocks, even this cycle, that have taken 30, 40, even 50 minutes to come in. So again, that's an average, but that's one of the geniuses of the Bitcoin Core protocol, that it has a sufficiently large enough sample size that we get a pretty good idea of what that difficulty adjustment needs to be, as opposed to other blockchains out there, other S coins that adjust their difficulty on the fly, and that has them seesawing difficulty up and down, kind of whipsawing back and forth. We get a relatively smooth trend up and to the right in Bitcoin difficulty in general, at least if you zoom out. There have been times when mining difficulty has been decreased for whatever reason, but in general, we have a nice gradual up and to the right, corresponding nicely with the price of Bitcoin as well. Real quick, I want to thank those of you listening on your favorite Podcasting 2.0 apps, such as Fountain. Podcasting 2.0 allows you to support your favorite podcast through the value for value model by either streaming sats on a per minute basis as you listen, or by sending sats along with a message in what's known as a boost, basically a shout out via the Lightning Network, where you can let us know what you think about the podcast. Just say hi, maybe let us know what's going on in your community, or just say thank you. But because it's a Lightning transaction, you're sending value back to this podcast in the form of Satoshis. And we do have one boost to read, and that is from longtime supporter of the podcast, longtime listener Leggy. Leggy sent 3,000 Satoshis and says, thanks. I think if you're able to save $20 a month, you already belong to the top 20% of the world. Leggy, of course, is referencing last episode where I mentioned that we were trying to stack enough, that we've already stacked enough sats to put us, in the top 10 or 20% of the world when it comes to hyper Bitcoinization, when we're trying to divide the 21 million Bitcoin evenly, or as close to evenly as we can, amongst the entire global population. Well, my immediate reaction to Leggy's boost is, of course, you're 100% correct, and I probably need to remember to strive to remain more humble. Partially, I was riffing unscripted, just like I was a second ago when I was trying to recall exactly what I said, and was struggling a little bit to articulate my thoughts at a time. And partially, it's just easy to view the world through a lens that is tinted by your own personal surroundings. Of course, I live in the United States, where the median income is a lot higher than it is in many, many places in the world, in most other places in the world. If you don't myopically talk about the United States or Europe or other developing or first world countries, there's billions of people that live in abject poverty compared to the way people live in the United States. So it's easy to tint your thoughts, to tint your surroundings through those lenses. But Leggy did make an excellent point with this boost, and so I wanted to know exactly what it would take to be in the top 20% of the world financially. So I dug in a little bit, and since this is 2024, instead of just cracking open the CIA World Factbook or sorting through mountains of surveys and studies, I simply asked ChatGPT, quote, what income puts you in the top 20% globally? And the answer was kind of broad, and it actually surprised me a little, but here's what ChatGPT had to say about what it takes to be in the top 20% financially in the global population. Based on the provided search results, here's a breakdown of the income ranges that place you in the top 20% globally. According to Zippia's 2023 data, and I actually don't know what that is, but ChatGPT is referencing it, the median global income is around $23,380. To be in the top 20%, you would need an income significantly higher than this median. A rough estimate would be an annual income of at least $50,000 to $60,000. Another Zippia snippet mentions that an income of $1 million puts you, or more, puts you in the top 1% worldwide. While this is above the top 20%, it gives an idea of the scale. To be in the top 20%, you would likely need an income of at least 4 to 5 times the median global income, which would be around $93,520 to $117,000. The Humphrey Yang snippet provides more specific data, citing the Survey of Consumer Finances from 2019. For those aged 45 to 49, an average annual income of $275,503 is required to be in the top 10%. So to be in the top 20%, you would likely need an income around 20 to 25% lower, which would be approximately $212,000 to $225,000. Keep in mind that these estimates are rough and based on limited data. The actual income required to be in the top 20% globally may vary depending on factors like location, occupation, and other economic indicators. However, based on these search results, an annual income of at least $50,000 to $225,000 would likely place you in the top 20% globally. Now, that's what ChatGPT has to say. And my reaction to that is, holy cow, that is a broad range. $50,000 to $225,000 is quite a broad range. And quite frankly, even if we look at the lower estimate of $50,000, that's actually quite a bit higher than what I would have guessed if I sat down and thought about it based on how much poverty there is in the world. So $50,000 before whatever taxes you're subject to in your part of the world works out to about $4,166 a month, or $961 a week. But again, that puts you in the top 20%. Clearly, there are billions of people surviving on a lot less. But at that $50,000 mark, if that is what is in the top 10%, I guess that would put you more in line with the average income in a first world country, or the bottom range of the middle class, or the top range of the impoverished class in most first world countries. And so Leggy had an excellent point that if you're listening to this podcast and you're making $50,000 a year or more, you're already in the top 20% of the world, and fortunate to be so. So once again, thank you, Leggy, for your support of this podcast. But more importantly, I truly appreciate that so many of your boosts have been probing or have inspired me to look further down other branches of the rabbit hole, and have been an opportunity to learn something that I wouldn't necessarily have otherwise. For example, diving into just exactly what it takes to be in the top 20% globally in this case. I also want to say thank you to everyone listening around the world. We just spoke about people in other portions of the world and what it takes to be average, regardless of where you may find yourself. And it is flattering to remember that we do have so many people listening from literally almost every country that you can think of. That wherever you may be, whatever circumstances you may find yourself in, there's a significant chance someone in your country is listening to this podcast. And that personally is really, really humbling. So speaking of where people are listening, the top 20 countries by listener remain as follows. The number one country by listenership remains the United States, with more than half of you. So thank you to those of you, my fellow Americans listening in the United States. Obviously, it makes sense that I'm recording this podcast in the United States, that this is an English language podcast. So it just seems natural to me that most of you would be listening to the United States. And in this case, it's a little more than half of you. So again, thank you to those of you listening to this podcast from right here in the United States of America, whatever state you may find yourself in. Number 2 remains Argentina. Again, that is extraordinarily flattering because, as Andreas Antonopoulos has said routinely, when he speaks to people in Argentina, he doesn't have to explain to them why they need Bitcoin. He just simply has to explain to them how they can use Bitcoin, because Argentina is a country where Unlike the United States, you have seen your currency devalued, debased. You've seen hyperinflation more than one time, probably in your lifetime alone. And so it's flattering that we have so many listeners in a country where Bitcoin can be more helpful more immediately than it can in other countries like the United States or places in Europe. But speaking of Europe, number 3 remains Germany. I guess I need to back up and say, hola, muchas gracias, amigos in Argentina, for coming in at number 2. Number 3 remains Germany, so guten Abend, soon to be guten Nacht, Dankeschön, mein Freunds in Deutschland. Number 4 remains Canada, so thank you to those of you listening up north, where I guess it's already starting to cool off. I've seen posts on social media of snow dusting the mountains, even in the United States, as far south as New Mexico. So it's obviously cooler up in Canada than it is in the southern half of the United States. So thank you to those of you listening in the soon-to-be-frozen white north. Number 5 remains Luxembourg. So Dankeschön, mein friends in Luxembourg, or Morgen to those of you listening in Luxembourg. Number 6 remains Spain. So once again, muchas gracias, amigos, in Spain. Number 7 remains Colombia. Hola, muchas gracias, amigos, in Colombia, another country where Bitcoin can be much more useful more immediately than it can here in the United States. Number 8 remains Mexico. So buenas noches, Dankeschön. I'm getting just tongue-tied today. I like to say that I grew up in the southwestern United States, and in the southwestern United States, you have a lot of Spanish speakers, and you have the majority or almost the majority of English speakers. I've actually lived in places where the majority of the population was Spanish speaking, not English speaking. But one thing that all of those places had in common is that definitely half the population spoke what we called Spanglish, and that's where you just casually blend English and Spanish together when you're talking, and you don't even really notice that you're doing so. And apparently, I have Germanglish, because I tend to blend German, Spanish, and English together by accident. But I digress. Muchas gracias, amigos, in Mexico. Number 9 remains Australia. It was cool to see Australia move back into the top 10 about 2 months ago now, and they've remained there ever since. So thank you to those of you listening in Australia. And number 10 has remained the United Kingdom, our cousins across the pond. So hello, good evening, whatever time it is when you're listening in the United Kingdom. Thank you for listening in numbers that put the United Kingdom in the top 10. Of course, those countries continue on. This data is broken down into the minutia, and you can just keep scrolling and scrolling and scrolling, and it really is flattering that we do have people listening from all over the world. So thank you to all of you, regardless of where you're listening. It is super humbling. All right, on to the news. As usual, the price is dominating the news. And I spoke a little bit about the 58K gang last week, and I wrote that Twitter post, that Twitter thread, where it was jokingly describing the principles of the 58K Bitcoin price. It was a lot of fun. If you didn't, I'd recommend going back and listening to last week's episode. Although last week's episode was a little disjointed, so I hopefully I'm a little bit more on my game this week. But speaking of the 58K gang, yesterday, Lena, and I don't know how to pronounce her last name. I've heard her name pronounced Lena Sichet repeatedly. She's German, so EI is usually pronounced I, like ice. So it'd be like Sichet. So I honestly don't know how to pronounce her name, but I'm going to call her Lena Sichet because every other Bitcoin podcast I've seen has called her that, even podcasts she's been on, and I've never heard her correct anybody. Anyway, Lena, she's the creator of the Littlest Hodler comic, and she posted a comic specifically referencing Bitcoin's 58K price. And it's the little hodler, and it shows him recapping the year, and it starts out with him in front of the pyramids saying, "This year I saw a lot of places, met lots of people, learned lots of things," showing Littlest Hodler surfing, probably a reference to the fact that Lena's living in El Salvador right now and has learned to surf. And then the Littlest Hodler talks to Bitcoin. It's facing Bitcoin. It says, "And you?" And then it breaks to a frame of the Littlest Hodler sitting on his haunches on the ground with a screen showing 58K and the Bitcoin price basically just sideways for a year. And obviously Bitcoin hasn't been at $58,000 for a year, not even close, but it certainly does feel like that. Again, last week we spoke about how that was reminiscent of 8K in the previous cycle, where it seemed like Bitcoin just couldn't break 10,000. Like it just kept coming back to 8K before, of course, exploding and going on to set, that the all-time high of $69,000 for that cycle. So once again, Lena absolutely nails it. I do love the Littlest Toddler comic. Uh, and if you don't follow Lena on Twitter, or you don't subscribe to her daily comics that she can send you by email, I'd recommend doing so you don't miss out, because they're always entertaining and they're always poignant. Speaking of Bitcoin's price and Bitcoin's price being down, September has consistently been the worst month for Bitcoin performance. On average, Bitcoin typically falls about 5% in September. Historically, August often marks a weakening of the uptrend of Bitcoin. I mentioned previously, when I was forecasting or predicting what a normal cycle would look like, that maybe we'd start gently coasting upward in the summer months. And traditionally in August, that upward trend tends to weaken a little bit. And then September is almost always a down month. In fact, more than 80% of all Septembers have been bearish for Bitcoin. In fact, Bitcoin has only recorded positive monthly returns in September twice since 2013. So it's not surprising that Bitcoin is down for many reasons, but not least of which is that markets in general tend to be down in September, not just Bitcoin, but stock markets around the world. Cointelegraph ran the headline yesterday: Bitcoin price loses traction as miner profits drop and spot BTC outflows persist. Bitcoin hadn't quite dropped as low as it did when this headline came out. I think it was around $60,000. And they were trying to pin this on the miner profits dropping. And of course, we have seen most of the Bitcoin ETFs have outflows, significant outflows, $200 million the other day, in fact. Although in general, we haven't seen outflows from the BlackRock ETF. They've only had outflows on a handful of days, and they've been really small. But Fidelity, for example, yesterday had relatively large, in fact, they led the outflows of the spot Bitcoin ETFs. CNBC ran the headline yesterday: beware of a Bitcoin backslide to $50,000 as it enters historically worst month of the year. It goes on to say Bitcoin sideways action could go on for another month as traders await a direction from U.S. interest rate cuts and the presidential election. As I mentioned, this is not unique to Bitcoin. September is historically bad for the stock market as well. Investopedia ran the headline yesterday: September has always been bad for stocks, but should you sell? The article said September is the only calendar month to average a negative return over the past 98 years. And Yahoo Finance ran the headline: why September is historically a bad month for U.S. markets. So you get the point. September tends to be a down month. And of course, they say that history doesn't always repeat, but it rhymes. So maybe Bitcoin breaks that trend, since we are approaching the halving-induced bull run, at least when I would have expected the halving-induced bull run to occur. But again, keep in mind, I didn't expect us to go zooming up and to the right until sometime this fall, closer to Thanksgiving or maybe even Christmas. Only time will tell. Nobody really has a crystal ball. But it's not just Bitcoin that comes under pressure. In October, the Yahoo Finance article was basically it was a link to a video. It only had a couple sentences, but basically it said U.S. stocks are under pressure as Wall Street kicks off its first trading day of September. The market's worst month historically is especially unique this time around as the Federal Reserve gears up for its first interest rate cut. Then they link to a video where they show some slides to say, why is September so bad for markets? And they kind of they pin it on a couple things, which I saw as a recurring theme. Oftentimes when you see the mainstream media talk about something, it seems like they all say like literally the exact same words, like they're reading talking points. And when we're talking about politics, because we all know the media is slanted in their political views and which candidates they tend to favor over others, they tend to literally repeat political party talking points. But in this case, they're talking about the stock market, and they were all parroting basically the same thing. They all said summer's over and traders are back to work, or something along those lines. And they said that basically when the traders come back to work, this is when they start doing their tax loss harvesting, particularly from mutual funds, and that leads to lower stock prices. Basically, I say blah, 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 smoke and mirrors. Typical every talking head has to tell you that they know the exact reason why a stock is down or why the broader markets are down, in this case, why they're down in September. And the point is that historically, for whatever reason, September has been a down month for many things, including Bitcoin. Speaking of down months, Atlas21.com ran an article entitled August was the worst month of 2024 in terms of profitability for Bitcoin miners. And we saw this referenced in one of the other headlines, the Cointelegraph headline that was pinning the price of Bitcoin on miner profits dropping. Of course, miners' profits always drop at the beginning of a halving cycle because the reward, the amount of Bitcoin they're getting for doing the same amount of work, is literally cut in half. And we all know that after the halving in previous cycles, the price of Bitcoin has usually gone down immediately after the halving and doesn't start trending up for 6, 18, perhaps even 6 months to a year, perhaps even as long as 18 months after the halving, to where the price of Bitcoin appreciates enough to make up for the fact that they're receiving 50% of the Bitcoin that they had been. So this is why we talk about miner capitulation, where that miner death spiral FUD had always come from, even though we've never seen that ever occur, and that's been thoroughly debunked. But the point being, this is the point in the Bitcoin cycle when the miners are always struggling. So to try and blame miner profitability for the price action isn't really taking into account that this is par for the course. This is really a nothing to see here. Of course, miner profitability is struggling. But the article goes on to say miner revenue dropped 10.5% in August compared to July, mostly due to lower transaction volumes and increased mining difficulty. Transaction fees accounted for just 2% of the block reward this month. Miners were actually getting kind of fat on block rewards. If you remember when fees were through the roof, there were a couple blocks where miners actually got more money in transaction fees than they did from the block the block subsidy, and that was before the halving even happened, and the reward was cut in half. So that was pretty significant, and that's evaporated. The article goes on to say, along those lines, it has been reported. Well, this is my words now. I'm going to paraphrase this because this article's kind of jumbled, but they report that that Bitcoin miners sold 2,655 Bitcoin this week alone, and that has a value of $154 million, or at least at the time this article is written. And while that's not necessarily as hefty as the billions of dollars we'd seen liquidated recently. Remember, Germany dumped billions of dollars of Bitcoin that they had seized not too terribly long ago. So $154 million is completely insignificant compared to that, but it is an example of continued downward price pressure. And speaking of exchanges, in the not your keys, not your news Bitcoin, this is a little bit of FUD that might actually be having more impact on the price of Bitcoin than people are crediting. In fact, I don't see an article out there even crediting this with downward pressure on Bitcoin price. But TechCrunch ran the headline: customers of Indian crypto exchange WazirX unlikely to recover full funds. Apparently, the largest cryptocurrency exchange in India suffered a hack and lost $234 million worth of cryptocurrency in July. Of course, the article goes on to say that they're unlikely to recover the funds in full. Duh. If they don't have the money to pay, if they don't have the money, they don't have the money to let their customers withdraw. I mean, that's a no-brainer, right? So the article quotes the director at the restructuring firm Kroll, which is, I guess, handling the situation for WazirX. The best case scenario is a return of anywhere between 55 and 57% of funds. Gui told journalists, under restructuring, Wazir's priority will be to distribute remaining token assets to users in a pro-rata manner via crypto, it said. The company is holding discussions to share profit from its revenue-generating products, it added, without giving any concrete details. The hack, which occurred in July, is the largest cryptocurrency theft in India to date and has sent shockwaves through the country's crypto industry. The company has been scrambling to find ways to return money to its customers ever since. In July, it proposed it would, quote, socialize the force majeure loss. Well, that sounds to me like a pretty rosy outlook if history is to be any guide. 57%, 55%, more than half of what the Bitcoin or cryptocurrency holders had in custody is certainly a lot more than had been recovered in plenty of other exchange collapses. So I wouldn't be surprised if we find out it's actually a lot worse than that. I shouldn't have to remind most of our listeners that the number one way people get screwed out of their Bitcoin is by leaving it on an exchange or in other third-party custody. We had the Mt. Gox collapse, the FTX debacle, all of the other custody solutions that were promising yield in the last cycle that collapsed, that cost plebs millions and millions of dollars and Bitcoin. But the biggest reason I'm pointing all this out is not because of the not your keys, not your Bitcoin, although that's certainly important, is that, remember, as we spoke about just a few seconds ago when we were talking about that we have listeners all over the world and we were talking about global income and what it takes to be in the top 20%, is that Bitcoin is a global phenomenon, and things that happen very far from where you and I may be at the time, wherever you may be listening, can have an impact on the ecosystem, even if it doesn't make the news in other parts of the globe. For example, I haven't heard anybody else talking about this in the United States. I saw that article when I was scrolling, searching, not trolling, but trawling for information for things to talk about. And when I was doing my podcast prep, and that was the first I'd heard of it, was just yesterday, for example. So $234 million may not seem like a large number compared again to FTX, but with India being the most populous country in the world, with 1/6 of the entire world's population, the FUD value of things going wrong in India, of things scaring people away from Bitcoin, spooking Bitcoin, can have an outsized impact. So even if the actual dollar value is a lot smaller than FTX or a lot smaller than Mt. Gox, it happened in a country where a significant portion of the world's population lives. So I wouldn't be surprised if this actually has a larger impact on Bitcoin's price action than what a lot of people are crediting. Specifically because I haven't heard many people in the Western media, in the United States at least, talking about it at all. Jurrien Timmer is back in the news. As you remember, we cite him from time to time because of his prediction that Bitcoin will hit $1 billion by 2038. Well, he said just the other day that he believes that this cycle's bull run has already peaked. He doesn't expect to see a cycle high until at least not one that's much higher than what we've already achieved. And that's quite shocking considering how bullish he is on his Bitcoin forecast, his $1 billion Bitcoin prediction. But I think it also betrays his lack of understanding of the Bitcoin cycle, that, he might realize that there is a Bitcoin cycle related to the halving, and then you get the pump and then you get the dump. You get the euphoria high and then we get the retracement and the Bitcoin winter, the sideways action, and then the accumulation phase, and then the crab market. And then the next halving occurs and rinse and repeat, it all happens again. But what I don't think he understands is that this pump that we saw, I don't think was related at all to the halving. It was completely, completely attributed to the hype that we had, the downright euphoria that we had related to the spot ETFs. And in that way, it was a lot like the euphoria phase that you get from the halving in a typical bull run, where, we get the 100K by conference day and people popping champagne corks thinking Bitcoin's going to the moon. They start talking about the super cycle, how there won't be an 80% retracement this time. There will never be another down market. It's going to be up and to the right forever as we've achieved hyper Bitcoinization. So there was a lot of that going on after the spot Bitcoin ETFs. In fact, people saying the cycles were over, that Wall Street was here, that because they were going to soak up so much Bitcoin now, the plebs were irrelevant. And that kind of euphoria, I think, is very reminiscent of the euphoria that we'll get at the peak when we do eventually have our face melting bull run as a result of the halving. But despite the fact they were similar, they were not the same thing. They were not related. They were completely separate events, and I think that's what Jurrien Timmer is missing. Lynn Alden was on the Cafe Bitcoin podcast Tuesday morning, and she gave multiple fact-based reasons why she believes Jurrien Timmer is wrong. First, she points out that Bitcoin's market cap to realized capitalization, or the actual cost basis, what people have actually paid for their Bitcoin, is far below levels that it historically gets to when we do have a blow-off top bull run. She also said that long-term hodlers typically begin to sell a little bit of their Bitcoin near the top, and that we haven't really seen much of that so far. And then finally, she said Bitcoin's correlation to global liquidity, which remains in a 2+ year consolidation, has yet to break out. That, we're on the verge of seeing an increase in global liquidity as the Federal Reserve begins to start printing money, cutting interest rates, and trying to pump pump dollars into the system to prevent a recession. That sort of thing's already just beginning to happen with other central banks all around the world. So she believes, and I believe this is the case too, that global liquidity is on track to go higher, to say the least, in the next 18 months. And that every time that has happened, Bitcoin tends to go higher as well. And so she says that she believes Bitcoin will track global liquidity. And so those are the reasons she thinks Jurian Timmer is wrong. Well, if all of this gloom and doom is shaking your strong hands a bit, relax, because while September historically has been a down month, October, or Uptober as it is often referred to, has been quite the opposite. And remember, this year, Uptober coincides with when I would have expected the halving cycle bull run to have actually kicked off, if not maybe just a little before so, if this had been a quote-unquote normal cycle. You know, I've mentioned this repeatedly, if probably ad nauseum in previous episodes, but this time I have crunched the numbers, and I have some very specific data that I would like to go over to make the case about why I don't think that the Bitcoin bull run, the halving-inspired bull run, has even begun to start yet. To get an overview, it is important to note that there have been 4 Bitcoin mining reward halvings so far, and we haven't experienced the cycle from the 4th halving yet, so it's kind of irrelevant. And the first halving was when when the protocol was first launched, and the miner reward was 50 Bitcoin, and it was reduced for the first time. We really didn't have any data to evaluate this by. The Bitcoin wasn't even initially traded at all, so there hadn't been any actual price discovery. So for this evaluation, our first cycle begins after that first halving at block 210,000, and that was on November 28th of 2012. And on that day, Bitcoin had a US dollar price of $12.40. And during that cycle, Bitcoin went on to have its first halving-induced bull run, going to a blow-off top from $12.40 all the way to $1,156.14 before crashing back down to $214.47 in April of 2015. And what we take away from that was the 2016 halving then crossed at a price on halving day of $680. And what's important to take away from that is that was 3.17 times the previous cycle's low. After the halving in 2016, Bitcoin, of course, exploded to around $20,000, depending where you get your data. It was less than 20,000. I'm using data from CoinMarketCap. They said the cycle high was $20,089 on December 17th. And then Bitcoin went on to retrace all the way to $3,400.82 on January 29th of 2019. And that's when that Bitcoin, please go to moon meme came out that I reference so often. The takeaway here is that Bitcoin crossed halving day at $8,590 on 2020, and that was 2.52 times the previous cycle low. So in 2024 on halving day, when the price was $64,024, that was out of line of the range of the 2.5 to 3 times the previous cycle low that we had seen in the previous cycles, the cycles that weren't tainted by the spot Bitcoin ETF hype, and the cycles where we didn't have a pre-halving second new all-time high, that we did this year before the 2024 halving. So if we had not had the spot hype ETF, I believe halving day would have looked more like those previous cycles where we came in 2.5 to 3 times the cycle low. So if we had come in at 2.5 times the previous cycle low, like in 2020, Bitcoin would have expected to be just $39,309 on halving day. And if we'd come in at 3.17 times the cycle low, Bitcoin would have come in like it did in 2016. Bitcoin would have been $49,448 on halving day. So what we got was obviously significantly higher. So if we had looked at historic data, we should have been expecting, without the golden swan of the ETF hype, Bitcoin to be in the $39,000 to $50,000 range. We are currently 136 days after. It's been 136 days since the 2024 halving, and at that point in time, in the 2016 halving, that would have corresponded to November 23rd of 2016. Bitcoin was $744.59. That was 9.49, almost 9.5% higher than on halving day. In 2020, at 136 days from the halving, that would have been September 25th, 2020, and Bitcoin was ringing in at $10,695.58, and that was a lot higher. That was 24.5% higher than the halving, but not actually at a new all-time high like we were at the 2024 halving. So choosing the highest end of the range, if Bitcoin would have been $49,448 US dollars at halving, and that's the highest range of that 2.5 to 3 times the previous cycle high. In 2016, when Bitcoin was 9.5% higher at this point in time in the halving cycle than on halving day, that means we'd expect to see a Bitcoin price of $54,140, which is significantly below where the price of Bitcoin is right now, even though, we did drop down to almost $55,000 last night. And if we had been like 2020, where it came in almost 25%, 24.5% higher, 136 days after the halving, Bitcoin would expected to be at $61,562. And of course, that's a little bit higher than we are, but not the $74,000 range that we jumped all the way up to as a result of the spot Bitcoin ETF halving. So, being generous, Bitcoin should have been expected to be between 54 and 61K right now, if this were a cycle that repeated or rhymed what we saw in the previous halving cycles, with 43,000, as low as 43,000, still being consistent with the previous range cycles. Again, what I believe is throwing everyone off is this golden swan pump that we got from the ETFs. In each previous halving, our all-time high occurred between 1 year and 18 months after the halving, which in this case would be somewhere between April and November of 2025, a heck of a long time from now, almost a year from now, more than a year from now if it takes till November of 2025. So getting back to our queries of AI, we queried ChatGPT earlier about what it takes to be in the top 20% globally, and so I queried AI about what it expects from the 2024 halving cycle, and AI said, a common pattern emerges from the previous halving cycles: a substantial rally leading up to the halving event, a brief correction, and a period of consolidation. In my words now, which is exactly what I predicted before the halving, even last fall, when I said, what should we expect from the upcoming 2024 halving? I said, we'll have a little bit of a rally leading up to the halving, and then a little bit of a sell the news event, and then a consolidation. And then I said we wouldn't see a bull run really kick off until we'd see the price start coasting up maybe this summer, but then it would be Christmas or Thanksgiving before we really saw the bull run kick off. But back to what AI says. AI says a major bull run and blow off top typically occurring around 18 months after the halving. Given this historical pattern, some experts predict a similar outcome for the 2024 halving. CoinCodex BTC price peaks above $170,000 in August of 2025, followed by a retracement to levels near 95,000 to 100,000. BitQuant, a new all-time high sometime during the pre-halving rally, with the post-halving peak seeing prices over $250,000. Marshall Beard, Gemini, a price figure of $100,000, assuming BT reaches its previous high of $69,000. Then AI quotes some unique factors from 2024, and it goes on to say that the spot Bitcoin ETF makes the 2024 halving cycle unique historically, and that interest rates are expected to be cut, and historically Bitcoin has performed well in a lower rate environment. Then ChatGPT's conclusion: based on historical analysis, the 2020 halving cycle is likely to follow a similar pattern, with a substantial rally leading up to the event, a brief correction, and a major bull run. However, the unique factors mentioned above may influence the outcome. It is essential to monitor market developments and expert insights to better understand the potential trajectory of Bitcoin price after the 2024 halving. So I know this is all just, guesswork. It's all looking into a crystal ball and relying on the large language model of ChatGPT to think what they think the halving will look like. And none of us will really know what this halving cycle will look like until after it's happened. Obviously, hindsight is 2020. But the general takeaway is that had this halving not been different with that euphoric pump we got, the early pump we got from the spot Bitcoin ETFs, that Bitcoin it needed to retrace from that halving, from that hype, and that without that hype, we would be looking at Bitcoin in the $43,000 to $60,000 range at this point in time during a normal cycle. So with Bitcoin trending back to 58,000, that's just price discovery, taking into account where Bitcoin should be. Price discovery, trying to figure out where Bitcoin should be based on the hype wearing off, the euphoric pump that went higher than it probably should have as a result of the spot Bitcoin ETFs. So to recap, in previous cycles, the price of Bitcoin in halving day was between 2.5 to 3 times the cycle low. If not for the spot ETF pump, we would have expected Bitcoin to be between 39,000 and 49,500 on the April 20th halving, instead of the $64,000 that we crossed the halving at. Bitcoin, therefore, is in price discovery as the ETF euphoria fades and before the supply shock-induced bull run would typically even begin. Plebs, we are still early in more ways than one. All right, enough of the news. On to what and my perhaps confusing take on where I think we should be in a normal quote-unquote bull run, which is what's a little uncomfortable for me to discuss because I believe, as I've said multiple times, I don't like to make price predictions, and I don't like to make predictions of any kind because I think nobody has a crystal ball. We don't really know what's going to happen. We don't know if the cycle of history will repeat or if it will rhyme, if there'll be a black swan, if there will be the golden swan like we had with the spot Bitcoin ETFs. So it's all just speculation. But that being said, on to what makes today and every Wednesday special. And that, of course, is that today is DCA Wednesday. And if you're just listening to us for the first time and you don't know what DCA is short for dollar cost averaging. And dollar cost averaging is an investment strategy where you invest your money in equal portions at regular intervals, regardless of price. Here on the Bitcoin Bulletin Podcast, we take advantage of the DCA strategy to stack sats every week, every Wednesday. So our regular interval is weekly on Wednesdays. And we chose $20 to be our equal portion because I believe that $20 is an amount that most people listening to the sound of my voice, tuning into this podcast, should be able to stack on a weekly basis. But again, these are you do you things. If $20 is more than you can afford, then whatever is appropriate for you. And if $20 is peanuts to you, if it's a meaningless amount of money, if you're a Michael Saylor type, obviously you would DCA a heck of a lot more. But we chose $20 to keep it simple and to keep it relatable for the most people that we possibly could. And so far, we've stacked 162 Wednesdays. We started all the way back on Wednesday, July 28th, 2021. And in those 162 Wednesdays, we've converted $3,240 into a stack of 9,806,222 sats. And we've done so at an average price of just $33,040.25. Because during the time that we've been doing this podcast, we started after 2021's double top, after the first top. So Bitcoin it peaked during the Elon pump, which I talked about as kind of a false start, not too dissimilar from what we saw. I believe what we saw with the spot Bitcoin ETFs, with the minor exception that it didn't happen before the halving. It happened right as Bitcoin should have been gearing up to have its halving induced bull run. So we started stacking as Bitcoin was trending down. And then we stacked all the way back up to its ultimate all-time high of that cycle, which was around 69,000. And then, of course, we stacked all the way down through the Bitcoin winter. We stacked all the way through the crab market. And we've stacked every week since. And as a result, our average purchase price was $33,040.25. That's not too shabby. Even with Bitcoin back down to 58,000, that's significantly more than the 33,040 that we're in for our stack. To grow that stack today, as usual, we're going to use the Cash App. I love Cash App for stacking small amounts of Bitcoin. If I'm stacking larger amounts, I use a different service because Cash App does charge higher fees than some other services, but they don't charge a mining fee when I go to transfer these sats to my hardware wallet. So in this case, I believe it makes up for those higher fees. Cash App is not a sponsor of the show. I just love using them. I've been using them every Wednesday for more than 3 years now. And if you do not use Cash App already and decide that you want to use Cash App, there is a referral code in the show notes, and I would ask that you please consider using that referral code when you sign up. That is just something that every person that uses Cash App has. It's nothing unique to the podcast. When you sign up for Cash App, you'll get your own referral code you can give friends and family. But the point is, you will get paid, I believe it's currently $5 for using that link when you do sign up. And the podcast will get $5 as well. And that means you'll be able to help support the podcast and actually get paid to do so. And so that's pretty cool. But again, they are not a sponsor of the podcast. And there may come a time when I decide to use a different service. But for today, I'm going to continue to use Cash App. I already have $20 in my Cash App, so it's just a matter of tapping Bitcoin, tapping buy, entering $20, and tapping confirm. And boom, we've just added another 33,673 sats to our stack. Bitcoin dipped a tiny bit while I've been talking. Not much. We purchased at a price of $58,059. And that 33,673 sats brought our stack up to 9,839,895 Satoshis. It also raised our average purchase price by about $90. So our average cost basis is now $33,130.43. Still not too shabby, considering the Bitcoin is ringing in at $58,000. And a price that I believe people will be calling us lucky when Bitcoin is $100,000 or $500,000 or $1 million or Jurrien Timmer's $1 billion one day. $33,000 is gonna seem to them in the future like buying Bitcoin in the early days for $1 a Bitcoin or $5 a Bitcoin or under $1,000 a Bitcoin seems to those of us now looking back at the people that got into Bitcoin before we got off zero. But if we decide that we were not going to stack a single extra Satoshi, which isn't true, we're going to stack every Wednesday until nobody's willing to sell us Bitcoin anymore. But even if we didn't, just taking our current stack, when Bitcoin does eventually hit $100,000, which I believe will be by the end of the year, but I guess we'll see, our stack will have a US dollar value of $9,839.89, and that is not too shabby, considering we stacked just $3,260 US dollars at only $20 a week. When Bitcoin hits $1 million one day, this stack would have a value in US dollar terms of $98,398.95, getting into the territory that people like Elizabeth Warren and Kamala Harris would call obscene and want to tax relentlessly because they think we wouldn't have worked to earn that. And if Fidelity's Jurrien Timmer was right about his initial prediction that Bitcoin does hit $1 billion one day, or by 2038, in fact, according to his prediction, that stack would have a value of $98 million, $398,950. So more than $98 million, which would be basically the same as when you talk about people that got into Bitcoin when you could still mine it on a laptop and they've got hundreds of millions of dollars now. Or if you'd bought just $1,000 for the Bitcoin when it was $1 a share, when people make those kind of comparisons, when Bitcoin hits $1 billion, they're going to be talking about the plebs that are making their first stack today in those terms, if that is the case. And that is really cool. But most importantly, you now have, if you've been stacking alongside us, significantly more Satoshis, more than 10x more Satoshis than the average pleb will ever be able to hope to accumulate when Bitcoin does hit hyper-Bitcoinization and everyone in the world is trying to get their fair share. We are significantly ahead like significantly ahead of the curve as far as that's concerned. And we did that stacking just $20 a week. If you have the means and you're stacking more than just $20 a week, obviously you're going to be sitting even prettier. That's going to wrap things up for this episode. But before I go, I want to ask you to help support the podcast by feeding that algorithm monster. If you're not already following us on Twitter or X, please consider doing so. On Twitter, we are at BTC Bulletin Pod. By increasing the number of followers we have on Twitter, it will increase the likelihood that people that are browsing Twitter, that are scrolling through X, will see our posts and maybe learn about Bitcoin, maybe learn about dollar cost averaging, and maybe you'll help orange pill somebody out there just simply by subscribing to us on Twitter. It also helps tremendously if you rate or review this podcast. The method for doing so varies depending on which platform you're listening to, but pretty much every platform, every app will let you rate or review this podcast. Obviously, a five-star rating would be amazing, but whatever you think is fair in your rating of this podcast would be appreciated. And just simply the act of rating the podcast, regardless of what you rate it, helps boost the podcast in the algorithm, helps more people potentially see this podcast when they're scrolling through Bitcoin podcasts looking for something to listen to. And maybe you'll help orange pill a couple of new plebs simply by rating or reviewing this episode that you're listening to right now. It's simply a matter of rating this podcast while you're listening can do miracles in feeding that algorithm monster. But even if it doesn't help support the podcast, even if you've already followed us on Twitter or you're already you've already rated this podcast, I like to hear what you have to say. It's great hearing from Leggy in the boost that they sent on the last episode. But even if you don't have the Satoshis, the means to support this podcast financially, I still want to hear from you. And you can do so by DMing me on Twitter, again, at BTC Bulletin Pod, or by sending me a good old-fashioned email. And the email for this podcast is bitcoinbulletin@protonmail.com. Again, at BTC Bulletin Pod on X or Twitter, and bitcoinbulletin@protonmail.com for the email. I check the email relatively frequently. In fact, I have it open right now. So if you do send me an email, I will see it and I will reply. But either way, I appreciate you listening. And don't forget to listen next Wednesday and every Wednesday, where we're going to grow that stack together to hopefully 10 million sats and beyond, as long as people are still willing to sell us Satoshis. But either way, keep on stacking those sats, you sexy sat stackers.